Great. Hello, everybody. Thank you for tuning in for another episode with Cash Property Inc. I am Huong Liu, and I have the great pleasure, one of my first female experts on our show. I'm going to let you introduce yourself because I still have a hard time saying your name. Okay, so I'm going to let you introduce yourself.
No problem.
But I'm really excited about this episode because we are going to get into part one. So there's going to be a part two follow-up, but this is part one of how real estate investors and other sort of wealthy individuals can divert some of their taxes and save a little bit more money. So I'm interested to learn more about this strategy. Okay, so I'm going to pass it over to you, let you introduce yourself, and then we'll get into the content of some of this stuff.
Hi, everyone. My name is Letitia Montana. Huong, thank you very much for having me on your show. My background is that I work as an insurance and investment advisor with one of Canada's largest brokerage firms called Hub Financial. And we are a nationwide brokerage, and we specialize in life and health insurance. And hopefully by the end of today's call, you'll understand why I was invited to speak and where that fits into real estate investing. I am a real estate investor myself. I started a few years ago with a flip. I thought it was a cool thing to do. I wanted to become a flipper. I found it to be very time consuming. And then my second flip became a buy and hold. And for my next move, I'm actually aspiring to become a multi-unit investor, hopefully with some joint venture partnerships. And as I was exploring real estate investing, I started attending a lot of the local groups. Groups perhaps such as Huong's group, primarily in the Toronto area. And what I realized was that while there was a lot of talk and education about how to invest in real estate and the various strategies that come with building wealth in real estate, there wasn't a lot of talk about how to make sure that once you build this wealth, how to make sure that it actually remains in your family and it doesn't get dissipated through taxes. This is something that the well-advised, wealthy individuals have known how to do for generations, and now it's our turn. And it just so happens that my work as an insurance advisor puts me in a unique position to know a little bit about wealth preservation. It's an area called wealth transfer, wealth preservation. And again, the wealthy have always known about these strategies, and since more and more Canadians are becoming wealthy through real estate investing, I think it's only fair that we should get in on that and know what's going on and how we can make sure that the wealth we work hard to build can actually remain in our families. Mm-hmm. So thanks again, Huong, for the opportunity.
You're welcome. So just before you get into the presentation, I just want to mention, so a lot of individuals, when they hear the word insurance come up, they just, a wall goes up. Right? So I just want to say, give us 10 minutes. Let me show you the presentation or the content, and just give us 10 minutes. Keep an open mind about the content, because really at the end of the day, you know, this is hard-earned money that you've made through real estate or through some other avenue, and you're going to, you know, be thinking about investing it in real estate or some other investment avenue. And this, you know, the 10 minutes or the next 15 minutes could be really instrumental in keeping that money in your family. Okay, so give us 10 minutes, keep an open mind. That's all I'm asking for. Okay.
Thank you for the vote of confidence, Huong, and for you keeping an open mind to what I have to share. So without further ado, I do have a few PowerPoint slides that I'd love to share with you. And we're going to stay right on topic, okay?
Hi, I'm Huong with Cash Property Inc. We help you, regardless of age, financial situation, and education, get as much money as you want. If you like our video, please click on the like buttons below and subscribe to our channel.
Let me just share my screen. So as you can see, my presentation is called Keeping Your Real Estate Wealth in the Family, Funding the Estate Tax Bill. So let's go into this very interesting topic that nobody wants to talk about, the two inevitabilities of life, death and taxes, the two certainties of life. So, you know, sooner or later, we all get to meet the maker, so to speak, and there are certain considerations that come with that, okay? Number one, we've all heard of probate fees. There are also executor fees, legal and accounting fees, the value of somebody's either private or public company shares that somebody may have. Equalization issues may come into play. And what I mean by that is, for example, a real estate investor could have 1 or 2 or 3 children, for example, maybe one of the kids is very interested in continuing the real estate business, managing the real estate. They may, however, have a child that has no interest in being a part of the business. They have their own life. They don't want to manage properties, and they don't necessarily care for that. So how do you make sure that when it comes to leaving your wealth behind to your loved ones, things can be done in a fair way, so that nobody feels left out or that things were not fair? Family and social legacies. Many real estate investors also have many of us contribute to various charities and causes that we care about, and could there be a way to make sure that we can actually live a longer term legacy even once we're no longer here? And finally, there's the final tax return, and we're going to talk about that. Okay, now a proper estate plan must consider all the assets somebody has. So somebody could have a business. This could be perhaps a real estate business, perhaps another active business somebody may have in a non-related industry. Most people own their primary residence. Some of us have registered assets, so RRSPs, TFSAs. When it comes to that, a lot of Canadians don't realize that RRSPs, when a person passes away, RRSPs, if you have any RRSPs left, they are fully taxable. There is a spousal rollover provision. However, if once they pass down, let's say, to the children, they are fully taxable. So the joke is that RRSPs are great, just don't die with them. Personal property, it depends where it is. If you have fancy collectible vehicles, that might become a taxable asset as well. So, and of course, the real estate portfolio in the middle, let's talk about that as well. So the question is, who will be the beneficiaries of your estate? Most people would like to see their children, grandchildren potentially, their favorite charity, hospital, church, university, whatever causes somebody cares about. Who will really be the beneficiaries of the estate? In the real world, unfortunately, the CRA is a silent beneficiary, and they come with open hands in that final hour and say, give us a big portion of your wealth, and we'll talk about where those taxes come in. So again, in the perfect world, ideally, we want our wealth going to beneficiary 1, beneficiary 2, beneficiary 3, our loved ones. In the real world, taxes make up a significant piece of where our estate could end up going in the absence of proper planning. So there are some tax exemptions given by the government. You may have heard of the primary residence exemption. So a capital gain on the principal residence is an exemption. So if you purchase your primary residence, let's say for $300,000, and by the time you pass away, it's worth $2 million, there won't be any taxes applicable on that. That's not the case, however, with investment properties, and we'll talk about that in a second. What are some of the other exemptions given? So there is something called a lifetime capital gains exemption on shares of a qualified small business or farm or fishing property. Now, what constitutes a qualified small business, you may wonder. As it happens, most buy and hold real estate corporations do not meet the CRA definition of a qualified small business. Typically, we're looking at an active income type business. Real estate investing, passive real estate, buy and hold real estate investing is considered passive. And typically, you'd have to have at least 5 employees. That may or may not be the case with many real estate investors. They usually run a pretty tight ship. So there are specific accounting principles that apply in order to be able to actually qualify for that. Growth in a tax-free savings account. So yeah, TFSA accounts, we all like TFSAs because while you are alive and well and money accumulates in there, the money is not taxed. And as it happens when you pass away as well, TFSAs are not taxed. Not the case with RRSPs, right? We already spoke about that. Lottery winnings, okay, great. Good luck, everyone. And then proceeds from a life insurance policy are actually also one of the few tax exemptions given by the government. Now let's talk about what taxes apply on real estate, you guys, particularly on investment real estate. According to the CRA, investment real estate is considered depreciable capital property. So there are 2 main taxes that we need to speak about. One is capital gains tax, and the second one being CCA recapture or recapture of depreciation. So what a lot of investors don't realize is that according to the CRA, there is something called deemed disposition of capital property. So we all know that if we're alive and well, let's say you sell one of your properties, you bought it for $300,000, you decide to sell it years later for $1 million. If that property was not your primary residence, but an investment property, you now owe the CRA capital gains tax. And if you've been depreciating your rental property, they also want whatever you've written off as depreciation expense, now they want it back as recapture depreciation. And I'll get into that in a second. But if you think about it, so what a lot of investors don't realize is that when you pass away, the same thing happens. So even though you haven't actually sold your assets, the CRA considered that you've actually just disposed of all your properties at fair market value. It's called a deemed disposition of capital property. Now, so getting back to this slide here, depreciable capital property includes buildings owned for rental purposes, tax deferral available where the property passes to the deceased spouse or spousal trust. So there is, the only deferral available is in the case of a married taxpayer, your properties can pass on a tax-free basis to your spouse. However, the moment the second passing happens and now the wealth is getting transferred to the next generation or to whoever else you want to leave your assets to, there is no further deferral of these taxes available, and that's when the big tax bill hits. So once again, otherwise the taxpayer is deemed to have disposed of all the property for proceeds equal to its fair market value prior to passing. So we can all do the math in our head, and I have one simple example here. So when it comes to depreciation, so once again, you guys, how depreciation works, we are, the CRA considers that we're allowed to depreciate rental property the same way we're allowed to depreciate a piece of machinery, for example. You know, they consider that it has a useful life. Typically for buildings acquired since 1988, the depreciation rate is 4% per year. So what that means is that over a 20-year property, you're allowed to depreciate down the property down to the cost base. So if you pay $300,000 for it, over a 20-year period, you're allowed to depreciate it down to whatever you pay, down to zero, so to speak. You can't depreciate it any more than that, okay? Now, why would an investor want to do that? Well, depreciation expense is one deductible against rental income, so you pay less tax on the rental income if you have one more deductible. So while you are alive and well and you own the property, you get to pay a little bit less tax on the rental income. However, you know, the moment you've sold that property or in that final hour, whatever you've depreciated, the CRA, they're not so generous. They want it back, okay? So that's how depreciation works, and the CCA recapture. So yeah, amount of depreciation deducted over the lifetime of the property must be paid back to the government on the final tax return. Okay, now, we've all spoken about, we spoke a little bit about capital gains tax. Let's just give another example of that, you guys, and I'll talk about this slide here in a minute. But we've already spoken about depreciation expense now and the recapture depreciation. Capital gains tax, you guys, we spoke about how if you bought a property for $300,000 and then you sold it so many years later for $1 million, the CRA considers, oh, you owe us capital gains tax. How capital gains tax is calculated? $1 million minus $300,000, that's $700,000. 50% of that gain is now taxable at your marginal tax rate. So it gets added to your tax return of that year, okay? And essentially you roughly, because presumably you're earning other income from other sources, it usually will put most people in the highest tax bracket once you add the taxable portion of the capital gains. So roughly we're talking about 50% of 50% being taxable. So roughly a quarter of the total gain ends up being owed to the CRA as capital gains tax. So of course, the longer somebody holds on to the property and the longer they live, when we're talking about that final tax return, the larger that tax liability is likely to get. So if you've only held on to a property for a few years and then you sold it, okay, there's going to be a gain, you're going to have to pay tax. It's not so severe. But in the case of buy and hold investors that now have a portfolio of multiple properties that they bought for not much, and now, you know, those properties keep appreciating. Even if you look at, you know, a conservative passive appreciation rate of 5% per annum, you can do the math and figure out how much, if you're fortunate enough to live to life expectancy, how much that tax bill is likely to be. So here we have a basic example. We have a couple age 45. They bought a triplex in the St. Catharines area. St. Catharines, for the rest of you in the rest of the country, is a small town about an hour and a half away from Toronto. Okay.
Yes, it's in Southern Ontario.
Okay. With a cost base of 500,000, and the average. So we're going to consider an average passive appreciation rate of 5%. The fair market value of that triplex by life expectancy of 90 ends up being $4.4 million. So even one $500,000 property bought when you were, in your 40s could end up being worth that much by the time, you or your husband are 90 years old. And then if you wonder, well, is that really realistic? Do people live till 90? What we know is that if a couple makes it to age 65, there is a 1 in 2 chance at least one of them will make it past age 90. Those are the statistics. Currently, life expectancy for women is 86. For men, it's 84. Every 10 years, we add a year to the average life expectancy. We are living in times of people taking better care of themselves. We have faster and better access to healthcare. So I would say that's not realistic. But if you don't think you're going to live that long, we can do the projection for a shorter life expectancy, okay? So just looking at those two taxes that we spoke about on this one property, based on this scenario, we would be looking at a total tax bill on this one property alone of $1.7 million. Okay, now again, you can do the math, and we could do the math together to see if you have a portfolio of properties, not just one, what we would be looking at in terms of, but roughly, if I actually did the numbers, this amounts to about 38% of what you are actually worth. So a lot of people say, oh, I'm worth so many million. How much are you really worth net of taxes? So where will the money come from to cover these expenses generating by somebody's passing? Well, somebody may say, well, maybe I'll refinance some of my properties, not me, but rather my heirs. And we got to ask ourselves, how available will credit be at that time? We all know mortgage criteria is just getting easier and easier to qualify for. I'm joking, of course. What kind of interest rates?
It's a lot harder to get qualification, right? So to expect that your children will be able to qualify for those properties, it might not be so simple for them.
It may not be so simple. And the other thing that I've noticed, and as you know, Huong, many real estate investors don't keep a lot of equity in their properties, especially when they're in that growth phase. I know, one of the most popular strategies, BRRR, buy, renovate, refinance, and rent. So in other words, you're always pulling out equity and reinvesting in other properties.
Right.
So you gotta ask yourself.
Leveraging, right. Exactly. Leveraging concept, yeah.
So again, big question mark whether or not your heirs, based on whatever mortgage qualification criteria will be available at that time, they'll be able to indeed refinance any of your properties. Somebody could say, well, I'll knowing that I have this multi-million-dollar tax bill when I pass away, maybe I'll just start saving for it. I would say, most investors that are getting beautiful returns investing in real estate, they're not too keen on the idea of putting money in a savings account, and what kind of interest rate will you need to earn to start to have millions of dollars available when you pass away? So we always say that, but really, how realistic is that? Or, the other thing is you could say, let the pieces fall where they may, which is the do nothing strategy. Your estate could cover the expenses. So the question is, will there be liquidity available to cover this tax bill? What is the opportunity cost? And I'm going to get into that in a second here. And the other final option would be through life insurance, and we're going to talk about that as well, you guys. Okay, so the do nothing solution, it seems like the easiest thing to do. And I've talked to some investors who say, well, you know what, my kids will be already much wealthier than I ever was. So I don't really care. They can deal with it. That's one way of looking at it. And if that's how you want to deal with your wealth, it's totally up to you. You want to be so generous and give potentially 38% of what you've worked hard to build to the CRA. That's definitely something you can do.
And I do agree on that. A lot of clients say that, you know what, they didn't have a silver spoon when they were growing up. So why are they giving that so much to their kids, right? And so if they just leave one or two properties, that's even more than what they had, right? And so their children should be able to, you know, live and survive and create their own wealth from one or two properties given to them, as opposed to inheriting the entire portfolio. So I hear that a lot as well.
Yeah, Hong, the one thing to keep in mind is that you're not obligated to leave your properties to your kids. However, given a choice between leaving a third or more of your estate to the CRA, or perhaps leaving some of your wealth to causes that you care about, whether it's a charity that you care deeply about, a cause that you care deeply about, potentially some of it to your children. I mean, most people that I speak to would still rather see their wealth go to their children, but some have more, you know, further concerns, you know, more humanitarian concerns. So I think this conversation is more about choice. It's really, the default choice is doing nothing and then letting the CRA get their piece. And what that may end up doing is actually the estate may be forced to sell assets. Oftentimes, you know, we all know, hey, estate sales is what everybody wants because it's a fire sale. An estate sale by default, you know, when taxes have to be paid within, you know, 6 months of somebody's passing at most, we don't know what kind of market conditions are going to be at the time. Presumably, these are properties that you've handpicked because they are cash flowing properties. These are the geese that lay the golden eggs. Do you want to kill the geese? Just, I mean, it's totally up to you. You know, you have that. Or would you rather? I mean, as an example, we could have things structured in a way that, you know, your properties get inherited by. There's so many. Really, that cash flow doesn't necessarily have to go to your kids if you don't want to if you don't think your kids are the most responsible stewards of that wealth. I think that's an unfortunate situation, but it can happen. It comes down to your choices, and it does involve some conversations. All of that, which, you know, myself and my team can help you do together with your other advisors, and we'll talk about that in a second. So, but again, talking about the do nothing solution. In the absence of other planning, this is where we see things like fire sales of assets. I was talking to another investor who was considering buying this commercial property. It was very weird. It was an estate sale. It was 1 in 10 properties, but the property was not even, the 10 properties were on the same strip, and this family had decided to sell one, it seemed random property in the middle of the strip. It wasn't even at the end. It was like, why would they sell? I mean, maybe it was just the children just didn't know any better. It could be. Okay, talking about the other solution, self-insuring right now. In other words, starting to save money to take care of the tax bill. Better than doing nothing, very sensitive to interest rates, still very costly. Like really, what kind of interest rates are you going to get to be able to save multi-millions of dollars? The insurance solution. So this is really the reason for our call. Insurance generally costs less than 1% of the overall assets on an annual basis. It's actually pennies on the dollar. The insurance solution, life insurance pays a cash benefit exactly when a person passes away, exactly when the money is needed, and it can be set up to pay on the second passing. So in the case of a married taxpayer, we know that tax liability hits after the second passing. We can structure an insurance solution in a way that exactly when that happens, money will be available, liquidity will be available. And it can be designed to return the face amount plus the cash value in the policy. We'll talk about that in a second. So yeah, what is life insurance? An amazing financial instrument. It allows one to create a large pool of capital, creates instant liquidity, creates an instant estate. So even somebody who has nothing else, they could be very wealthy when they pass away because they've bought an insurance policy. For real estate investors, insurance really can provide the liquidity that's needed to take care of the tax bill, so that we avoid that situation where your loved ones are now in a situation where they have to potentially fire sale assets. So all with the stroke of a pen, many wonderful uses for this product. I'm not sure how educated your listeners are, Hong. There are 2 types of policies in the marketplace. People may have heard of what's called term insurance, and then we have permanent policies. Term insurance, it starts off as being very inexpensive, later on becomes very expensive. Permanent insurance, you can choose to do as a pay-as-you-go, also known as a T to 100, pay-as-you-go all the way to age 100, or you have the option of compressing premiums, maybe only paying for 10 or 20 years, and then the policy still remains in force for life. Let me see here. So I know this slide here looks a little confusing. What it's meant to show is that some insurance policies of a permanent nature have what's known as a cash value component. And how that works is that when a policyholder makes the policy, the premium deposits, a portion of that gets put into this investment account that's attached to the policy. And then a portion of the money goes to actually fund what says monthly charges for insurance. So the actual cost that is based on the person's age, smoking status, health, and so on. The accumulation in that cash value of the policy is on a tax deferred basis. As long as the money is held inside the plan, as you can see, the CRA cannot touch it. And these types of accumulations inside these policies can be really, really beautiful over time, depending on the type of plan we're looking at. And again, in the realm of permanent policies, we have different types of products out there. But, you know, you could be looking at 4 to 6% net steady eddy type returns. We're not wanting to compare this to the returns you may be getting from real estate investing. This is really there to act as a buffer and as a protector for your real estate wealth. I don't want to get too much into details of that. Suffice it to say there are different types of policies and then different things you can do with that cash value accumulation. Yes, what this slide shows is that as money accumulates in that investment account, you can access that accumulation during the lifetime of the policy, usually via a policy loan. Some policies will allow you to do a direct withdrawal. That's usually not to your advantage because the moment you do a direct withdrawal, number one, you're going to get taxed on any growth that's happened in the policy, but also you may affect the actual life insurance benefit of the policy. So a better way to do it is via a collateral loan. Think about it as a home equity line of credit, except instead of you borrowing against the equity in your home, you're borrowing against the equity of your policy. And all the banks in their private banking division are very familiar with these types of plans. Some of these companies have had these products on the books, companies like Canada Life, over 150 years. So these products are nothing new. Banks are familiar with them. Don't go to your teller at the bank. Again, my brokerage, we have banking relationships with all the different major banks. We have preferred relationships and we know where to go in case, you can go to the insurance companies themselves. However, sometimes it may be more beneficial to go to one of the banks. You may get a better interest rate when it comes to accessing your funds. And the advantage to especially an investor accessing this cash value of the policy is that you can now access the money and reinvest it in your business, reinvest it in your real estate business. You're not, if you don't like getting 4 to 6%, you're still, the way the policies are structured is that even though you access the accumulation via policy loan, the insurance company still pays you, in this case, a dividend every year. You really get to have your cake and eat it too. Meanwhile, you're now taking that cash and reinvesting it in your real estate business and potentially earning 20% returns. So it's really a win-win. You get to have the best of both worlds. You get to have your cake and eat it too. And it gets even better. I'll get into that in a second. So here we just did an illustration. And by the way, guys, this is illustrated for a 68-year-old couple. These premiums, obviously a lot of you are not yet at that stage of life. And it's ideal that you start considering these issues before you get to that age. Number one reason being, as we get older, sometimes our health may not stay the same as it is when we're young and healthy right now. So, Huong, I know you got to go soon, but this is an example of different types of permanent policies that can be put in place. Again, the numbers were done for a 68-year-old couple. I can tell you that for, let's say, a 45-year-old couple, numbers can look a lot better. So this was for a $1 million joint last to die policy, meaning benefit being paid on the second passing. This is the first option is a Manulife pay-as-you-go type of plan. As you can see, premiums would be $22,000 per year, and they have to be paid potentially till age 100. I mean, if they're fortunate enough to make it to that age, okay. The other option would be a compressed premium schedule. Maybe you only pay for 10 years and then you're done paying. I had a client last year, 67 years old. He said, you know what, I want to pay for the premium while I'm still in good health. I don't want to have to worry about, who knows, having to pay a premium when I'm 85 years old. Who knows what kind of health I'm going to be in at the time. So those options are available, doing a compressed premium schedule. This is the third option is the 20-pay type option. And then option D is something I know Huong really wants to hear about. It's something called the immediate financing arrangement. So as you can see, you guys, that shows as a net zero outlay. Very briefly, what an immediate financing arrangement is, before I even explain that, you may say, well, you know, Letitia, I like what you're saying here. I understand I have this huge tax bill on my portfolio that it's eventually going to hit. I'm only deferring it, but eventually it's going to hit. But I'm not happy paying $10,000 or $20,000 a year in insurance premiums. I'd rather keep that money and invest it in my real estate business. The immediate financing arrangement strategy, which, by the way, is designed for affluent clients. Lenders understand the situation. Insurance companies understand the situation. If you're a successful entrepreneur or investor earning 20% plus per year in your real estate business, you're going to be hesitant to tie up your capital paying for an insurance premium. So what they're willing to do, and again, it is on a case-by-case basis. They will have to look at your entire financial picture to see if they're comfortable. Not only will they, so it works with policies that have a cash value component. So what they'll do is they'll collateralize that cash value of the policy from year one. In the initial years, what you pay in premium may not, what you have in the cash value accumulation may be less, typically is less than what you paid in premium in the initial years. Typically at least years 1 through 5, sometimes years 1 through 10. So what they're going to ask from you as an investor is, if you want to pull out the entire amount, let's say the premium was $50,000, to give you an example, for this multi-million-dollar permanent life insurance policy. And in the initial year, you only have $30,000 in that cash value accumulation. They can collateralize up to 100% of that $30,000. You need to come up with an extra $20,000 as collateral. That collateral can be provided in the forms of, typically they want to see unencumbered real estate. However, I know that doesn't work for most investors. All the real estate has mortgages on it. They will take a bank letter of credit. There are a few other things that they're willing to consider. So that's why I say it's on a case-by-case basis. But you may have to come up, if you want to be able to borrow back the entire amount of your premium so that your net out-of-pocket is actually zero, you pay the premium and then you borrow it right back. The next year, you do the same thing. In the initial years, with every year, that cash value of the policy gets larger and larger. So after a while, you're actually not going to need to provide any additional collateral because the cash value of the policy now provides full collateral. So the moment you pay the premium, you're able to borrow back the entire amount, reinvest in your real estate business. Okay. I know it can be a little confusing, but the idea is,
I think it would be really useful to have that explanation that you talked about actually drawn out and done on a whiteboard, and then we can actually go through an actual example of what that would be like, right? So that might be a good segue for us to end now and go into part 2 and say, okay, as a real estate investor or a business owner, this is what you would do with option D, right? And then what an actual example would look like with that $100,000 that you're talking about.
Absolutely. And again, I do have some extra slides that go into that. I just need to rearrange them, and we'll do that in a part 2. Absolutely, Huong. Let me see if I think I have a couple of extra slides. That's it. So we really are at the end of this portion of the presentation, part 1. Hopefully that, you know, at least made you think and gave you something to think about.
Yep.
And in case
the purpose of this part 1 was to really show the why. Right? Because a lot of people do glaze over. As soon as you say insurance, they have like no interest at all in it, right? Because they think, well, I need a ton of money for it, or I need to be in this situation for it, or I need to have kids, or, you know, whatever the situation might be, they have an excuse why insurance isn't right for them, right? But at some point, it does make sense to say, okay, well, maybe now I should be looking at this IFA, right? And so, you know, for a lot of my coaching clients, an IFA makes sense. Right. And so in order for them to get that, to get to the part 2, this part 1 is really important for them to understand the why.
Thanks for, I'm glad you feel that way, Hong. I feel the same way because I feel that if we had explained the intricacies of the IFA strategies without first explaining, why do I need an insurance policy? Please tell me. I think I'm wealthy. I don't need insurance.
Yeah.
That's, Sun Life Financial is, one of the companies that specializes in working with the affluent, and they did a survey, and something like 55% of the affluent thought they don't need insurance because they can self-insure.
Yeah,
The well-advised affluent learned that, you can really have your cake and eat it too, and you can actually leave a lot more wealth behind. You can actually live closer to what you actually think you're worth, net of taxes, Yeah,
and leaving it to your kids, but it's also leaving it to a charity of your choice, right? So whether, like, for me, my charities of choice is the Habitat for Humanity and the Foundation for Fighting Blindness. And if I know that I can leave a huge portion of the wealth that I've made to those two organizations, right, that's fantastic, right? Like there's so much money there. Like what you were saying, like we're talking, upwards of $1 million plus.
Oh,
right?
Yeah. You're wealthier than you think, especially, and you're going to be, I know it sounds like cliche, but really when you look at the future value of that real estate that you bought, maybe for not very much initially, but if you're lucky enough to live to life expectancy, you really are worth a lot to your loved ones, to the causes that you support, and also to the CRA. So how can we make sure you direct that wealth to the causes that you care about?
All right. And before I forget, I am not a financial advisor, I'm not a lawyer, and I'm not an accountant. So all of the information that I'm presenting is really just my ideas, my advice, my opinion. So before you implement any of it, get somebody else's opinion on this. Show them my video and see what they say. Okay. So just a little disclaimer there. So